Formal welcome to March's virtual boardroom, hosted by FD Recruit and in conjunction with FRP Advisory in Brighton. So our two speakers today, we've got Adrian Alexander, who's Corporate Finance Partner with FRP, and Neville Side, who's Restructuring Advisory Partner. I believe that's your correct title, Neville. They're going to be giving a presentation today, which is looking at the current trading issues through distress solutions and the M&A landscape, valuations and exit options. Known Adrian for quite a long time now, and any advice that I've heard them give, it's never particularly relevant to me, but there's always been good information in there. The Bank of England, the last one that I went to, the quarterly update over in Brighton was particularly good. And I even managed to stay awake. So they're going to talk through the current situation at the moment. And as I said, there's chance for Q&A at the end. And if for any reason you want to reach out afterwards to Neville, Adrian, the FRP team, or ourselves, then feel free to do so. So it's with great pleasure that I hand over to, I'm going to assume Neville first because he's unmuted, and then Adrian will jump in. And then, as we say, once they've wrapped up, we'll open the floor up to questions and answers. So over to you, Neville.
Thanks very much, Stuart. Yes, as you say, I'm the one who's unmuted. We've had a minor sort of technological issue in terms of it hasn't quite worked out how we were hoping it was going to work out in terms of our presenting. So we will do this very much in two stages. I'll do the first part of our presentation, and then I shall try and mute myself. Adrian will try and unmute himself, and then Adrian do the second part. Yeah, first things first, thank you so much for inviting us along, Stuart, to present to you today, and hello to everyone who is watching and listening in. Delighted to have this opportunity to talk to you. As Stuart says, it is a very interesting time at the moment. We have this sort of slightly unusual time where both our corporate finance team are very busy, and equally on the restructuring and insolvency side, we're also incredibly busy. Normally these two things are counter-cyclical, but at the moment we're both experiencing large numbers of inquiries and large numbers of transactions. So it's a sort of a fairly unique time for us to talk to you about both sides of the spectrum, really, and that's what we're gonna try and do today. So, as you have already done a great job, Stuart, I obviously won't focus on this side. As Stuart says, I'm a restructuring advisory partner down here in Brighton. Essentially, what that means is I'm dealing with businesses in distressed situations, financially challenging situations. And Adrian, as you say, is a corporate finance partner leading our team down here in Brighton and focused across the southeast region. I'll very quickly, very quick overview of FRP. Hopefully you'll have all heard of us, FRP Advisory. We are essentially an accountancy firm, but we don't do audit and tax. So we are entirely focused on the advisory function of accounting. We have grown significantly since we started 15 years ago. And as you can see from the numbers there, we've got over 30 offices around the UK, plus a couple of international offices, just over 100 partners. And I think we're near enough 900 members of staff now across all of those offices. And we are focused on these sort of 5 key pillars, as we call them, of the advisory space. So Adrian and we're bookending those pillars there. Adrian on the corporate finance side, and myself on the restructuring side. Those are the sort of the 2 areas that we'll talk to you about today. And as I say, we're bookending those 3 in the middle, which is debt advisory. It does what it says on the tin, where we are helping businesses raise debt, and again that's at both or at all stages throughout that corporate life cycle. Financial advisory, which can be anything from helping businesses whilst they're going through a sort of a very solvent, successful sale process, all the way down to getting into the nitty-gritty of working through MI and understanding why businesses perhaps aren't working as well as they'd like to. And then forensic services, which again where there are investigations or things that need looking into in greater detail, we have a specialist team that look at that side of things. So as you can see there, what that means is that, across those 5 pillars, we are able to advise businesses right the way through the corporate life cycle. Adrian, obviously on the corporate finance side, tends to focus more on the left-hand side of that page there, and I, generally speaking, tend to focus on the right-hand side. And ideally, if I do my job correctly, then that downward curve stops, it plateaus, and then starts to move back up again. And Adrian comes involved on a further slide that isn't even on there. So as I said, right the way across the corporate life cycle, we are able to advise. Now, other thing I would also say, we've probably got too many slides today for the amount of time that you want us to talk to. So I shall sort of rush through a couple of the slides, but we've kept them in there just because that we felt they'll be relevant for you if we're going to provide this to you, which I'm sure we're very happy to do so as a sort of an aid memoir going forward. There are bits and pieces that will be of interest for you going forwards, but I will not dwell on them in any great detail. And as Stuart has sort of said, so the focus of my side of things is going to be looking very much at some of the current issues that the UK economy and lots of UK businesses, UK SMEs are facing, and also are potentially likely to face over the course of the rest of this year. And then moving on to look at, well, what does that mean for businesses that are facing stressed or distressed situations that aren't yet necessarily in a sort of a turmoil of insolvency, but are looking very much at the start of that downward decline curve. How can we help them? So these, I suppose, are the main areas that we're seeing at the moment that businesses are struggling with. There's been a lot of uncertainty towards the end of last year. I think there was uncertainty in the lead up to the budget. And then, of course, the budget was delayed near enough to the end of the year. And so there's a lot of decision making that has been delayed. And again, I think the sort of the global shocks that have happened at the start of this year have caused further uncertainty, which again is delaying key decisions that businesses need to make. We have, as I said, seen these global shocks that are already happening, which put pressures, particularly for importers and exporters, on those supply chain, increasing costs of doing businesses where you are doing business outside of the UK. There is quite clearly, one of the issues why the budget was delayed. There is an issue. There was a bit of a hole in the public purse, and there is pressure on those government agencies to collect in monies that are owed to it. And we are certainly seeing that on the restructuring, the insolvency side, a real uptick in sort of, I suppose, activity that HMRC are taking to recover monies. Energy costs, I'm sure, we'll have all seen that over the past couple of years. And unfortunately, it looks like we're now about to experience that, or businesses are certainly about to experience that again. But I suppose one of the main challenges we're also seeing is that everyone's in the same boat. Everyone's struggling. So in situations where we would ordinarily advise on sort of stakeholder management, asking everyone to buy into the same story in order to help people through, you're seeing some businesses coming back and saying, well, if I try and alleviate some of the pressure on you, it's just increasing the pressure on my business. So why should I do that? There is, as we all know, a cost of living crisis. Wage inflation is not going up significantly over the past couple of years, certainly not in line with cost inflation, which means that consumer confidence is down, and that is really impacting on businesses in certain sectors, which I'll come on to on the next couple of slides, and you'll see clearly there. The costs of doing business, minimum wage increases, national insurance contributions increases, all these things that you'll have heard huge amounts about in the press. They are now really starting to kick in to business, and we are certainly seeing that. On the plus side, business was expecting interest rates to start going down this year. Certainly, I think we were expecting probably at least 2 rate cuts this year. Interest rates were held in the last month's MPC meeting, and there's a possibility that they may even go up if inflation starts going up above the sort of that. I think it's at 3% at the moment, so well above that 2% target. If interest rates go up, then again the knock-on effect on business is going to be quite significant. The economic climate generally and business confidence generally is low, and has been for quite some time. And that again is just impacting on businesses not making those decisions to invest and to grow. And finally, we got sort of tertiary lenders and COVID loans in there. It might seem as though that was a long time ago, but most of those COVID loans were for a period of 5 or 6 years. They were done in 2020, 2021. So a number of those loans are coming to the end of their period. Tertiary lenders did an awful lot of that lending, proportionally far greater than their share of the market. And we're finding that tertiary lenders are taking a more aggressive stance towards recovery. So all of those things all together mean that businesses, generally speaking, being hit with a bit of a perfect storm of troublesome times ahead. I won't dwell on this side. Insolvency basically is well up. The top number there, which you can see in the box of roughly 24,000 insolvencies last year. To put that into context, in pre-COVID, sort of 2018, 2019, the normal number of insolvencies a year would be about 16 to 17,000. So, and what we've seen is since 2023, 2024, 2025, the numbers have all been up around the 22, 23, 24,000. So there are large numbers of insolvencies. But if you, from that little graph on the right, what you can see there, what we would class as the rescue culture of insolvency, which is administrations and CVAs, they are the red and the yellow parts of those bars. And as you can see, they make up only a tiny percentage. So the majority of insolvencies are very much the death of businesses that have perhaps just gone too far and not sought help while they can. Where I talked about that sort of consumer confidence being low, and sort of cost of living crisis, etc., national minimum wage increases, national insurance contributions, that's really impacted on sort of that on the hospitality sector, which again is one of the main sectors where we have seen insolvencies. It's not the largest. The largest has been construction. That always tends to be the largest sector where we see insolvency. But again, it is impacted by a cost of living crisis, by consumer confidence being low. But equally, it's where margins are so tight, and where there are significant penalties for delays. So that particular sector is always susceptible to more insolvency than perhaps some of the other sectors are. So sort of moving on to what should directors do? Again, I'm going to sort of rush over this slide quite quickly. Hopefully it's generally speaking what you'd all expect to do anyway if you found yourselves in a situation where a business was in decline, and there was a risk of insolvency somewhere down the line. In reality, those are the sort of the main headings. Take professional advice. Of course, I'm going to say that because I have a self-interest in it. But in reality, it is the strongest defense that any directors can really have if they find themselves in a scenario where a business has gone into an insolvency process and their actions in the lead up to insolvency are being challenged. Essentially burying your head in the sand, hoping that things were going to come good without taking professional advice is essentially the most dangerous thing that you can do. Minuting your decisions, taking decisions on a regular basis, again, that's absolutely key. When you find yourself in court, you need to have evidence that you were considering everything. Cash flow forecasts will be key. Having regular updated cash flows that are done on a daily basis, over a very short period of time. So we're looking at cash flows that are, as I say, done on a daily basis for a 13-week period, rather than looking at P&Ls, budgets for a 12-month period or beyond. Once you start to get into that decline curve, you really need to be looking at the absolute short term. Cash is king, and therefore, that short-term cash flow forecast will play a large part in determining whether or not you are acting reasonably prior to a potential insolvency process. And then those along the bottom, again, having indemnity insurance in place ensures that you are protecting yourself and protecting the businesses. Acting in good faith, we'd expect directors to be doing that anyway. And then that last one you may or may not have heard of, but essentially what that boils down to is once a business has a real threat of insolvency, your duties change from being towards the company and its shareholders to acting in the interests of the company's creditors. So it's fundamentally different, particularly for owner-managed businesses, where the directors are also shareholders and they are looking at potentially losing a business that they have built and that they hold the equity value in. Again, I won't look at this. I've left this slide in here because it's something that you might want to consider at a later date. But these are all the sort of the normal warning signs and red flags that we'd expect for businesses that are suffering financial difficulty. Some of the main ones that we're seeing at the moment are probably costs not really being aligned with income, where costs are increasing and income is not increasing alongside that. Tertiary lenders, as I've said, taking a very, very aggressive stance towards recovering monies. Those are, I suppose, the main ones. Directors' loans, again, increased directors' loans in businesses that have gone bust. So I suppose, what do we do? How can we help? And what's the duty of directors in situations such as this? Just because a company is facing insolvency, it doesn't mean that you immediately close the doors and look to shut down the business. There are always options. The most important bit of advice that I can always say is the earlier that you act, the more options there will be. But fundamentally, so long as, again, if you are in this situation, as long as you are monitoring that short-term cash flow forecast, what we would do in these scenarios is try and look at where the potential quick wins are. How can you improve your working capital management? What is it within your business that's causing you fundamentally the main problems? How do you increase your cash runway? Because as I said, cash is king. If you run out of cash, that is what will bring your business down. So a real focus on that short-term cash flow forecast and increasing the runway is important. We tend to act on behalf of banks in these situations. So again, the focus of that will always be, is this actually a viable business? What are the true financial needs of a business whilst it's going through difficulty? A lot of directors tend to provide the answer that they think the bank wants to hear rather than the actual answer. The worst thing that banks can hear is, this is what we thought it was going to be, but it's actually turned out to be worse than that, because directors have produced a cash flow forecast where they thought they could manage based upon the existing facilities they have available to them, rather than saying, actually, this is what we need in order to get through this. And then that's where we will help the bank make a decision around that. Stakeholder management, I've already alluded to that before, where I talked about everyone being in the same boat. But one of the key, I suppose, the key aspects that we bring to businesses that are in distress is we bring a different badge. We bring a badge which says, actually, this business is in trouble. And the fact that we are here demonstrates that. We are then able to, if required, get involved in conversations with those stakeholders to help them understand the benefits of working together with a company that's in distress, rather than acting against it, where it thinks that the right action to take is to demand money straight away. Actually, that could be the worst possible action that particular third-party stakeholder might be taking. So we're able to help that. Business sales is another one. We're finding business sales are taking longer in order to execute. It may be that the business needs further time in order to execute a business sale before insolvency comes along. So we find ourselves acting in scenarios where that is the case, and again, potentially advising stakeholders where the benefit of them supporting businesses is whilst they go through troubled times in advance of a potential sale. And of course, critically, contingency planning, ensuring that directors don't just travel on ahead, regardless, that there are sort of time-bound action plans, that if something hasn't happened by a certain point in time, then this is the next stage that you need to be considering. And that can ultimately end up in an accelerated mergers and acquisitions process, or potentially a business and asset sale through an insolvency process. But it's understanding and advising them on what is the best time to do that, or the most appropriate time to do that. So again, these are the sorts of reports that we would do. I will not go into any detail. They do pretty much say exactly what they are there. They vary in terms of, I suppose, the level of time that we have available to do a report. the level of detail that's required for a report, and the understanding that we need to have of a business in order to advise them on a way through it. And as I said, the most important thing that I can say there is the earlier that we become involved, the better advice that we can provide, the more options there are available to them. And I don't. I shall probably. I shall leave the case studies until the end if we've got time to come back to that. And that will probably bring this a bit more to life. But I shall otherwise hand over to Adrian to talk about the corporate finance.
Afternoon, everybody. Not pleased to meet you all. So just picking up on the corporate finance side, so corporate finance partner based throughout the southeast. Probably just picking up on some of the points that Nev's just mentioned, and so the parallels of things that are going on in the market. I guess, as we all know, the sort of macroeconomic things have affected the business world for a number of years. And I think one of the interesting things now is that I think businesses have become more resilient and just almost expected something to happen each year. But I think during that journey, when people are considering their priorities, owners still age, they still want to look at exit planning and things like that, and they've sort of realised they just can't wait for that sort of perfect market. The things we've seen in the corporate finance market, predominantly sort of, I guess, for 2 years leading up to last autumn, UK trade buyers were really not out to play. So a lot of our transactions, even at the smaller owner managed business end of the market, were attracted interest from overseas buyers. And it's quite interesting to see that we talk the UK market down and how we are doing, but actually a lot of overseas buyers. And in our own team, we've seen a lot from European buyers in Sweden, Italy, Spain, Scandinavian countries, really interested in investing in the UK. So which is really a feature of the market for that period. We did see at the autumn last year UK buyers becoming more active. And I think, and then from the summer through to obviously the current last few weeks, a lot of activity, renewed activity amongst the corporate finance community. Got a bit of buzz back again, I think, within that community. Private equity houses still got a lot of dry powder, a lot of funds that they want to invest. Clearly, they're cautious. There's a lot of noise around that marketplace. They probably do a lot less deals. Well, they do a lot less deals than the corporates. But for the right deal, still interested in the right sector. Banks are cautious, but are telling us they're open. They will fund deals. And then if the banks are struggling to do the deals, then there are solutions from alternative debt providers. And Neville pointed out that we do have a very active debt advisory team, and I think that was on a call, and got about 5 or 6 deals to close this week, for example. And then we do everything from £2 or £3 million debt providers up to into hundreds of millions, so we can cover that side off. The valuation, we're going to come back to that in a second. Quite as always, there's an expectation gap between buyers and sellers. Over the years, sellers have an amazing capacity to not actually understand what's going on around them and still want the top dollar for their businesses. But I guess that's what drives that type of individual. Impact of AI obviously is important in deals and how different sectors or companies are dealing with that. Probably big question we're getting asked now is if they're in a sector or doing something which could be impacted by AI, how they're dealing with, how they're embracing that. Could they lose market share if they're not doing it properly? And obviously the last 2 points. I was writing the day before the Middle East war started. We signed off on an article which said, I actually used the word stability in it, I think. And then the Middle East war started, and then on the Monday before I posted my LinkedIn post, I had to say, well, maybe that was shouldn't have words like stability in it. But capital gains tax, there wasn't any changes in this spring, which was great for the first time for many years. Who knows what's going to happen in the Middle East? As yet, it's probably too early to tell. We've seen 1 or 2 processes where deals have been renegotiated already, but I think that may well have been down to due diligence rather than just necessarily market conditions. So where does that leave you if you're either a business owner or you're advising a business owner? And obviously, this is this diagram I've had for years. Really, the idea here is that you sell on the upward curve. You can see there, we're leaving something in it for the buyer. Hopefully, you don't get to the point, or the business doesn't get to the point with a dotted white line that goes down, in which case you will probably be needing to see Nev, because that's the business is starting to trend the wrong way. And therefore, the idea is to try and pick that time. But market's not the only issue. So I spoke at an economics seminar recently, and actually Stuart referred to it. And we had a Bank of England speaker who had lots of very interesting diagrams, but I thought mine was better actually. So I've put this chaos slide together with overlaying that point, the perfect point for the company. You've got to look at other factors. So you have the sector side, the red. Each sector will have its own cycle. And our owners who reach retirement age, the green line is the energy levels, and then actually trying to pick the best time there is quite difficult. But yeah, you need, again, take advice early as to when that point might be. And I think, as someone was telling me, in terms of personal investment and everything, you can't always just pick the market. Sometimes you've just got to do it when it's right, when it's the right time for you. How do we go about deciding when and how much do you want to get for your business? The starting point for most of the conversations I have with my clients is the valuation of the business. I would say over 35 plus years of selling businesses, I've only 2 or 3 times had to tell somebody their business was worth more than they think it is. So most of the time I'm delivering bad news regarding the value of the businesses. By the time they reach us, they may well have had all sorts of information fed to them, and there's various reasons, just that they don't understand the multiples, where they've come from, etc., or how we actually do the structure of how a valuation mechanism actually works. So we try and get our clients off that sort of mantra and say, well, how much do you actually need? And so we take clients to the left-hand side of this graph. How much is trying to take a strategic and a holistic approach to their affairs, and get them to think about what they need in terms of their personal wealth. All the stakeholders work out what they want, need, talk to an IFA, financial wealth planner, so they can actually do cash flow planning, and then from that they come back with a capital sum that's needed from the business. And quite often that discussion, the output of that can be actually what we were targeting, £10 million. That's what they always wanted, and the mantra is we want 10 million quid. And you go to say, well, why do you want that? Do you need 10 million? And actually the number could be a bit lower. And sometimes actually the wealth planning brings better news, because you don't need as much as you think you do when you sell a business. You're probably not going to be doing world tours when you're 100. You're probably going to be in a nursing home, so you don't necessarily spend as much money as you think you might. So once we've got that target number, we can then decide, okay, the business needs to grow. If you do need to get to the 10 million, then how do you get the business there? So there's a whole planning process around organic growth, or do you need to do an acquisition maybe if you can't get there organically? And then the timing point that we just talked about. That's the left-hand side. Right-hand side is all the different exit options. Trade sale at the top of that list is still the predominant exit route for companies. We spend 80% of our time doing trade sales. Two-step exits is a form of management buyout, which I'll come back to shortly. I've got a few slides on that, which is a sort of evolution of a management buyout. IPO, not necessarily very rarely for the sort of owner-managed business at the lower mid-market is going to want to do IPOs. Management buyout is a more traditional buyout where the management team knock on the door. The owners need to go out and raise private equity and or bank debt and then buy the business. They've gone out of fashion a little bit just due to a lot of those businesses that did those highly leveraged management buyouts ended up failing. And hence the two-step exit is an alternative that I'll come back to. EOTs, employee ownership trusts, that was very favourable for tax purposes, went from 0% to 50%, or 50% of the gain can be treated as zero in the last budget in the autumn. Slightly less favourable, but that's a starting point for a lot of the conversations. A merger, when two businesses come together, no money changes hands, but you're a bigger business, smaller stake, maybe a better exit route. Do that first before you acquire. I did say I'll talk about valuation. Obviously, a lot of people on the call, I'm sure you've all got different experiences in valuing businesses, and I mentioned getting a lot of people get this wrong. The left-hand side is the equation. It's essentially working out what the sustainable EBITDA is, the maintainable position that you're passing to the buyer. That means adding back all the costs of the owners, deducting a true market cost, and dealing with a lot of exceptional costs and things that might have gone through the business. So, I mean, if you're an FD in your business and you're valuing them, it's quite good to track that. Start looking back over a number of years and actually having some method of recording that information. So that is an easier sort of ask when we come to talk about that. EBITDA multiples driven by the factors on that graph. I won't go through all of those, but clearly, if you've got a business which is larger, size does matter, and we'll come back to that in a second. Well, I mean, picking off there is growth prospects, scalability of the business. If you've got barriers to entry, that sort of thing, in your sector, then that will drive multiple. That then gives you the end. I mean, and actually, one of the problems in the market, EBITDA multiples, is the sources of that information. So it's essentially flawed because it's usually based on public information and the filed accounts and probably poor information about the deal. Nobody really knows if a £5 million deal was 2 million in cash and 3 million earn out. Did they ever get the earn out and that sort of thing? So essentially, people usually think the EBITDA multiples is higher than actually the reality of it is. That provides enterprise value. And then the other reason there's a misunderstanding of valuations is that you then have to deduct the financial debt or add surplus cash to that, just if the normalised working capital. So a lot of businesses, they come to me, they haven't taken into account the fact they've got a £3 million overdraft, which they need to deduct to come to that valuation. How do you increase value? I mean, you've got the touched on some of those things there. I won't go into this, but you can see as you go through that swoosh going up, between the 3.5 times EBITDA, maybe up to the 8 times. The things you need to do in positioning the brand, show you've got really good growth in a sector that's really resilient, and all those things. Then getting that strategic premium. And as I say, size matters. You can see at the yellow bit at the bottom, smaller businesses will be at the end of that, and higher EBITDA businesses are deemed to be more stable and therefore attract higher multiples. What do we see? Some of the reasons people misunderstand the EBITDA multiples is actually what part, there's the jargon that might be using the wrong point on the balance sheet, on the P&L, sorry, which is a P ratio, for example, as an after-tax ratio rather than an EBITDA multiple, which is higher up the P&L. Headline multiples, we've just discussed maybe out just for the reasons that we discussed. Actually, market conditions at the lower mid-market don't drive the multiple that much. It is more the size, and then you typically got the range there, higher multiples for faster growing companies. And one reference point we use actually is the UK 200 group, which do an index every November. They actually do analyse all their deals, so but they're basing it on more accurate information. Usually that's deals around an average of 5 or 6 million across all those accountancy firms, and you can see that really the outlier there was 6 times in November 21 following COVID and following deal activity, but rest of the time it's sort of got around 5 times, and it's actually gone down to 4.5 times in November. So I'll just touch on the two-step exit. There's a form of a management buyout. We found, when you're talking about exit to clients and companies, the trade sale isn't always the right way forward for companies. Particularly if you're in a sector or a business where you've got a project-based business where you're reliant on future projects, don't have a lot of recurring income, professional services type consultancy businesses where you're very reliant on individuals and people, typically you won't get as much cash at completion, and you get more on earn out than you would in, say, selling a manufacturing business. And then if you sort of think about the construction sector, I sometimes talk to my clients, well, do you trust a trade buyer to pay you and earn out half the money afterwards? And then typically, compared to, say, a management team buying the business and owing you money, a lot of our clients would choose the management team rather than the trade buyer. In addition, so we use this planning in a situation where the owners don't necessarily want to get out completely at step one. They want to stay involved. They don't want to retire straight away. They want to stay around to support the management team, and actually they believe over a period of time there's really good growth for their business, but they want to start stepping back. So this process, that's that. So I've got a bit of a complicated slide here, but we use a typical opco newco structure, and typically the current owners will have a retained stake, usually less than 25% of the share capital between them. They have loan notes, which bridge the gap between the value and some cash if it's available. And step one involves planning around that side. The new shareholders management team come in. There's ways that they don't actually have to pay for all of their shares. We use a thing called unpaid uncalled share capital. Doesn't create directors' loans and all the tax issues of the directors overdrawn current accounts, etc. Motivates the management, so they have a potential of a minority discount, and of course the business is actually valued a lot lower, always lower after the cash has been taken from the business and the loan notes introduced. So, and then you end up with hopefully ended up with a motivated manager. The owner's still involved in the business. The owner starts to potentially step back between step one and step two. And you then have, what we do then have is a pre-planned step two, typically 3 or 5 years, when any loan notes have been paid. There may be some debt have been introduced, small amount of debt to fund the cash at completion. That's been repaid, and we put in place a put and call option that may kick in after 5 years. We roll forward the valuation mechanism, so that it essentially becomes plug and play, and then the management team then buy the rest of the shares, from the owners, or potentially trade sale then becomes step two. We do have a number of clients that make that opt to do that. Seller benefits there on the left hand side. They get their succession plan. They lock in the CGT regime, so their loan notes and the cash would be taxed at CGT rates and at the current rates, rather than risking future changes. Motivated management team, you're aligning goals between the various stakeholders in the business, and in theory, if the business grows, the sum of the two parts are greater than the whole. A management team get a meaningful stake in the business compared to a situation like an EOT, where all the employees have to participate. You can pick and choose who is involved from the management team in this structure. The other points I made, can be paid over time. Don't have to work for a trade buyer. The current owner's still around to help, and then we have very little gearing, so the business is not at risk. I'm on to case studies. I think I've got some case studies as well. I think, Stuart, I don't know how much time we've got left. Whether you want us to talk further, or should we just take questions at this stage?
Probably a good time to take questions. If that's a slide that you can share with people that are interested, then I think that'd be really worthwhile. But I think the value of the kind of advice that you and Nev have given so far has been invaluable. So I'll leave it to Christiane to open it up to questions. I think
if anybody wants to add any questions into the Q&A box or into the chat, feel free. Or raise your hand and I can allow you to talk if there's anybody who has got anything they want to ask.
Come on, don't be shy.
You stunned everybody into silence.
I think that's the general consensus.
I say if there aren't any questions, then I will happily go through the case studies and put you through a bit more of us talking.
I'm going to kick it off. So it seems like obviously we've been looking at barriers and we've been looking at the tough trading conditions. In your professional opinion, what are the biggest opportunities in the markets at the moment? We're obviously seeing an upside. We're seeing it on the recruitment side, so it's obviously trickling down to us, and it's normally slightly delayed from yourselves. But if you had to put your, a finger on it, where would you say those opportunities are?
Shall I go? I mean, certainly from my side of things, I suppose the one thing that I would always say is a sort of simple fact of life is that wherever there's a loser, there's also a winner. And where we are seeing businesses that are in trouble, if they can't find a way through it, then ultimately there's an opportunity there for someone else. Fundamentally, there is an underlying business which has normally been successful for quite a long period of time, and then it's just been hit, like as we are seeing at the moment, by this sort of perfect storm that proves to be too much for a business to sort of ride through. Some of the slightly bigger businesses, the more experienced, those that I suppose have a sort of greater backlog of cash resource to get them through it. There's the opportunity there for them to pick up businesses normally out of an insolvency process, but pick up businesses that are cheap, and then sort of do a bit of cost rationalization and come out of the other side of it. But that's where I say I'd see sort of the greatest opportunity within my world.
Yeah.
Yeah, I think, I mean, the corporate finance side, I think, yeah, I mean, obviously there are the obvious sectors that are attracting interest, private equity, anything to do with AI or, sort of SaaS businesses, compliance type businesses. But I wouldn't want everybody on the call to think it's that more traditional businesses aren't of interest, and actually, both to trade buyers and PE, there's opportunity there. I think there are. I mean, organic growth has been hard work over the last few years for a lot of big companies, and actually those that do need to grow, they've got shareholders to answer to, listed companies, that sort of thing. But PE backed businesses that need to grow to exit, they really quite often need to do acquisitions in order to grow. So it's almost, unless it's a complete meltdown in the market, those companies are still there. They still want to acquire. They need to acquire to grow. So if you're in a business that's looking to exit, then that you shouldn't be put off by what's going on in the market. But I think I come back to my chaos graph at the start. I think you've really got to work out, if you're in that mindset or you're advising companies in that mindset, is to work out what's best and the timing for the client, for the stakeholders, and every situation is different. But don't be put off by what's going on in the short term market. You've got to have that longer term strategic view. And I think getting advisors involved early, both corporate finance or your existing trusted advisors or lawyers, and then helping to prep the business. If we're in there early, we can help get the businesses ready as well, or we use the time between once the strategy and the timetable's been put together. Assuming the businesses still walk through our doors and say, "Sell me now," in whatever condition, but some planning would be good. But don't be put off with what's going on in the market. Work out what's best for you, I would say, would be my advice.
So we have got a couple of questions come in. So this is from Shirley, and I'm not going to attempt the surname. That would be very bad of me. What is the best way for FDs to help owners plan for exit?
Yeah, I mean, just exactly what I was just saying there. I think it's an early engagement for a start. Once there's a plan, we're working out what they actually, having a starting point is actually have that realistic discussion I said about the value. So understanding if you've been involved in valuing business, finding you think you can have a sensible discussion with your clients about, that's fine. If not, get some advice into actually, because the worst thing is when somebody thinks it is worth 10 million and it's only really worth 5. That early discussion. Then from that, work out what the timetable is to exit, and then it's getting into the granular detail. So as an FD in the business, too many transactions, you get to the end of the transaction and you find the management information isn't good enough. There's contract hasn't been renewed. There's a lot of stuff there. All that granular detail, that really boring stuff, that may well come back to bite businesses. And if there's some time to put all that right, it really helps the process. And if businesses have never done forecasting, for example, why would someone rely on the forecast just for the sale process? Because you've got no track record in forecasting. Yeah. If you go into the private equity market, you need really good quality management information. But yeah, the boring stuff, contracts, employees, contracts, all that stuff here within the data room, just making sure you've collected and you know where all the information is, put a data room together, and engage with advisors on all different colours who get involved in transactions early to get them, and then work together as a team.
Excellent. Next question's from Shirley Priestley. Is everybody called Shirley? Would early advice even be good as far as 3 years ahead of planned exit?
Perfect timing, yeah. 3 years.
Perfect.
So as and when. I mean, and also we start talking to, you put a plan together. I mean, things change over 3 years, but you just, if you started with a plan, you've then got the basics of the plan. Things change, stakeholders change, shareholders change. You can adapt it as you go, but at least you've got a base to start from. So 3 years is a perfect time.
Excellent. We got a question from Tanya Spicer. In the current slowdown, who are you seeing come out strongest in project-based construction, and what are they doing differently?
I'd say it's a bit of a challenging one, because the ones that I see, generally speaking, are the ones that that are coming out the I suppose the least best, as it were. But from those, I would say that we're seeing that are going under within construction. It really is management of margins and understanding the business and understanding your margins. There's a lot of similarities, bizarrely, sort of between what Adrian says and what I say, regardless of the fact that we're at different ends of the spectrum. The businesses that go under are the ones that have I suppose, generally speaking, the poorest MI, the poorest forecasting. Don't get me wrong, that's not all. There are some businesses that are just hit with an unfortunate event that they couldn't possibly plan for, and it's an event that's of such significance or at such a particular point in time that it ultimately is something that a business can't, as I say, ride out the wave. But generally speaking, I would say that's the issue we have, is sort of poor management team, poor forecasting, poor financials. They're the ones that in the construction space that suffer the most, because the margins are so tight. And that applies across the board, really, across all businesses. It's amazing at the moment how many businesses we are seeing that have been run successfully for 10, 15, 20 years, but actually they don't really know why they've been successful. And the problem with that is then they don't also know why they are not being successful, and they're not able to react quickly. Over the last couple of years, as I said, there's been all the things that I sort of put in that very first slide that have been there for a couple of years. Are all challenges that businesses that have been affecting business, and businesses that can't react quickly are those that have tended to suffer the worst.
I think on the sales side, if it presented the business sell project-based businesses, obviously back to that recurring revenue bit that we were talking about. I know if you've got a well-spread customer base, the ones that are most difficult to sell are the ones that have got all of their eggs with one client or one customer. I did sell a business years ago, and I think it was 95% of its business with one customer. Big deal. The buyer actually lost the customer after 18 months because they messed it up, believe it or not. So that took 3 years to sell it. So spread customer. I think the recent experience in the construction sector is around people have been caught where they do a lot of public sector work, and then the public sector projects get pulled. So if you can got a nice balance between public sector and private projects, that absolutely helps, because obviously that's less risky for the buyers. So bit of
spread betting going on there. So I think we've got one final question. This is from Ali Tomlin. How do you approach getting to a more realistic valuation and managing expectations early on? There's seemingly always word of mouth suggesting higher valuations than are realistic.
Yeah, it's a very good question.
I think you've answered your own question there, Ali, a little bit. But
yeah, absolutely. I mean, I think again, it comes back to that early advice, doesn't it? And actually, I could joke that someone's talked about down the golf club that someone said I got 8 times from a business, or 7 times, and it should have been 5. But was it based on filed accounts that weren't properly adjusted? Was it based on an overzealous corporate finance advisor hyping his deal to say it was 5 million and not 4.25? So you got 2 by a higher number divided by a 2 lower number, which gives you these the 2 high multiples. So it's it is difficult, but I think actually back to my my signpost slide, actually, by taking owners owners very sort of driven by, they want a target, and the reason they're very successful entrepreneurs, they have targets, they really want to get there, but it's just trying to get them off the agenda that I want this. I've always wanted 10 million pounds for my business. That's been my target my whole life. But how do you want 10 million? No, I want 10 million. So it's actually getting them onto how much do I need, and getting to engage early with lifestyle. What if you don't want a super yacht and a house on every continent and an Learjet, people don't need as much money as they think they do, actually. So it's getting to talk about those issues. We don't necessarily have to be involved in those, but we just need to know the number that comes out of that money. But it is. I joke about having to tell some of their businesses worth, only 3 times I've had to tell them it's worth more than it is. I mean, that's not that much of an exaggeration, to be honest. So it's a problem. But I think it's incumbent on all the advisors to, their account, the accountants. So I think a lot of entrepreneurs are, they're quite forceful people, and I think a lot of people sort of tell them what they want to hear sometimes. And actually, we need to be realistic, have that a realistic discussion with them, and actually say, look, you need to really understand how it works.
Brilliant. I think that wraps us up. So I'm going to bring this to a close. Thanks to Adrian and Neville for that advice, the questions and answers at the end as well. I know it's putting you on the spot slightly. As I say, we will be asking you whether you want to share your contact details, and obviously we will put everybody in touch that does. But for now, probably a Jerry Springer final thought. Follow Adrian on LinkedIn, and any advice that he gives or any statements that he makes probably sounds like it'd be wise to do the opposite when it comes to world politics and conflicts in the Middle East. But really, thank you for your time, and we will see you hopefully on the next boardroom.
Thank you for the opportunity. Thanks a lot.
Thank you.
Thank you.
No problem.